Our goal here is to have a very honest, candid conversation. So hope you guys come out of this with some useful insights. My name is Michelle. I'm the Regional Director for Endeavor Catalyst. Endeavor Catalyst is Endeavor's co-investment fund. We manage about $700 million in AUM. We've made 400 investments globally, of which we've backed 45 African companies. So before I introduce my panelists, I want to contextualize a few things about this topic. We're talking about down rounds, flat rounds, shutdowns, very heavy topics, but this is not just an African issue, it's a global issue. So allow me to leave you with a few stats before we dive in. So US down rounds at the peak of 2022 only contributed to 7% of all VC rounds in the US. By 2023, that number had risen to 14%, and by mid-2024, that number was nearly 30% of all venture deals done in the US. So this reset is not just happening in Africa, it's a global reset. So with that, I hope we're able to dive into some interesting things with our founders. I'll ask each of you to introduce yourselves because I feel like you'll do a much better job than I will. And tell us a bit about yourself and a bit about your company. Wanda, I'll ask you to kick us off. First, because I'm wearing Vivo. And then you're the furthest down my right. And then JC, you can go and then followed by Azmat.
All right, wonderful. Well, hello, everyone. My name is Wanda Gishru. I run the Vivo Fashion group, which is a vertically integrated fashion company. We design, manufacture everything we sell here in Kenya. We sell across 3 markets. So Kenya, we have 26 stores in Kenya, 2 in Uganda, 1 in Rwanda. We also have a subsidiary business, which is an e-commerce marketplace called Shop Zetu. We employ about 450 people, and we've been in business for 15 years now.
Thank you so much. JC, over to you.
Hi, everyone. Great to be here. My name is Jean-Claude Omao, co-founder and CEO of Lori Systems. Lori was founded about 10 years ago and is the leading logistics coordination platform operating in East Africa and West Africa. Specifically, what Lori does is we address one of the most critical problems we see on the continent, which is that while most of the goods in this room, so every chair, every bottle of water, all the food that you're eating, the coffee that you're drinking, has to move on a truck at some point in its life cycle, transportation logistics in Africa is the most expensive anywhere in the world. So it's a serious problem that ends up contributing to the cost of goods in Africa. It's the reason why goods are so expensive. In the US, logistics contributes around 6% to the cost of goods. In Africa, it can be up to 75% of the cost of goods. So Lori's solution to this problem historically has been that we've built a large network of SME transporters that own thousands of trucks in aggregate. And we coordinate cargo, capacity, and capital to have those trucks lift cargo and move more efficiently. And so we've done this for 10 years. We were founded in 2016. Over that period of time, there haven't been any macro shocks or crises in Africa. So we've done really, really well. No, just kidding. There's been so much happening, both from mistakes we made and from what happened in the ecosystem. So look forward to sharing how we survived that and came around to improving our model to where we are today. Thanks.
We'll definitely dive into that. Azmat, please close us off before we...
I'm Azmat. I'm 2 times founder. I actually went from one wealth management and payment startup based in London, serving family offices, to starting a startup in mobility fintech in Africa, which just closed one of the largest seed rounds, raising $45 million. We got to $20 million annual recurring revenue in the first 18 months of operations. And we're growing quite fast now. But I mean, probably the reason I was invited to this panel, I was thinking that maybe it's a caution for us because, because it's been a big start, but it's also something where I can share with you maybe this journey from doing one business, closing it down, and starting another.
Fantastic. Eager to hear all about that. So, JC, I want us to kick off with you. Lori was founded in 2016. You guys scaled to build a significant platform, 20,000 tracks across 12 countries, 10 billion plus in goods moved, 50 million ARR. It was a huge achievement. What parts of those core elements of that business model worked well and what didn't? And how has that reframed your building for this next 5 to 10 years?
Sure. Yes, we did achieve quite a lot. And I think fundamentally the parts of this business that still hold true today are the size of the opportunity, the size of the problem, and the fact that the solution does lie in working through the participants in the market, which are the SMEs, and solving a financing issue. Now, some of these insights were learned over the past 10 years of trials and tribulations, and I would say so the ones that didn't hold true, the ones that I would point to.
I think use the microphone because it's coming in
Can
and
you all
out.
hear me?
It's coming in and out.
Okay. So the parts that hold true are, as I mentioned, the size of the opportunity, working through the participants in the market, which are the SMEs. And perhaps the ones that collapsed over the years were things like valuation or how we saw the role of working capital financing. For years, we saw it as a market friction. The fact that we had to provide working capital to the SMEs that were loading cargo for us seemed like a burden. And it took years for us to fully realize that it was the central problem that needed solving. It wasn't just an impediment. Also, you shared a few dates around down rounds and how 2024 figures within that. At our peak around 21, 22, Lori was moving on an annualized basis $50 million of revenue and $3.5 million of gross profit. And then, very suddenly, all of these crises came. I would say one of the main issues was our valuation, right? We had a sort of pre-COVID 2019 valuation that was, very close to 9 figures. And after these crises, after the reset, even valuation of companies was completely reset. And what you found was that, between having foreign investors on our cap table who were no longer seeing the Africa opportunity that had led them to invest, and a very high valuation, you found yourself in really an impossible place of new fundamentals, a rebased way of evaluating companies that was no longer applicable to where we were. So really, the financial side of things, valuation of the company, which was very high for a Series A, and also a delayed appreciation for the role of financing our partners or our customers and the importance that had to the business.
Thank you so much. And I just want to stick with you because I think you've touched on the central piece that I want you to go deeper on, and that's the valuation piece. That's not easy, right? From a team morale perspective, the conversations you're having with your investors, the perception in the market. So take us through that moment. What are some of the key decisions you made when you were thinking about restructuring and lowering your valuation? But also, how did that inform how you'll look at capital raising in the future?
Sure. So as I mentioned, our sort of pre-COVID Series A post-Series A evaluation was close to 9 figures, and that was a very rich valuation by by any valuation. But those were the times, right? So you don't say no, you take it and you go forward. By the time we were restructuring in 24, we were one of the many companies that had to do that in 2024. The whole thing started with a belief that the company still had the product market fit, the industry size, the market opportunity to make it, right? So that was my conviction. And after a long period of trying to fundraise in 23 and 24 and realizing, hey, you're running out of cash, this journey is almost over, what I decided to do at the time was to complete a management buyout. So spoke to a few advisors and told them, listen, not able to raise capital for this business. I'm not quite ready to walk away. If I can buy it for $1 and rebuild it from scratch, I'm ready to do it. And I called a couple of investors that were friends and started having this conversation with them saying, hey, I've never done a management buyout. How do you do that? And through that process, by the end of those conversations, they told me, if you actually go ahead with this, I'll back you. That led to a conversation with a law firm that advised me not to do a management buyout because of the liability, but proposed a pay-to-play. And so, in order to give the old investors an opportunity to invest, to give the new investors that were taking a chance, an ownership stake that made it attractive to them, and ensure that myself and my management team also were allocated. We did a pay-to-play with a massive down round, which could have been ego bruising, but seeing as the alternative was a management buyout at $1, it was not too hard to beat that valuation. So eventually we got that round closed and fully restructured the cap table, our debt, our board, our executive team, and started our new journey.
Amazing. Azamat, I want to move to you, and if you could tell us a bit about the GoCab story, because you guys have built and achieved significant growth in the past 18 months since you've launched, but you've also raised substantial capital. You mentioned $45 million in both equity and debt, I believe. So how are you thinking about growth, but also building a financially resilient company?
Yes, I mean, I wanted to maybe give a little bit color on the story. My background is in asset management. So I've been investing for quite a long time myself. So I've been on the other side of the table. And that's why when it came to fundraising, I would say, super conservative myself. So I have not started fundraising before we went into profit. Because I remember when you are the investor, basically, when you talk to a founder which has a short runway, you have the cards, right? As the famous now saying about having the cards, it's a popular saying. When you are the startup which is in profit, you're not pressured, and there is no timing, sort of time limit on the race. That was number one. Number two, it was reasonable valuation in terms of multiples on EBITDA, not multiples on revenue, which is very important. I think in post-COVID reality that I think investors now have more realistic understanding of the valuations, apart from AI space, which is still a bubble. But everything else, I think now people understand more. I mean, people, I don't know, they see Klarna valuation now, right, as a public company, which is valued at 4 billion. At the peak, it was, I think 45 billion. So there are a lot of stories around that. Basically, when this fintech hype valuations, I think they came down, and it's all about bottom line. And that's why having this sober and realistic understanding of valuation and numbers, and having financial discipline is a core principle that we followed since we started. And because, again, we had a very big why behind this business, I would say that that was the main reason we attracted quite significant interest from the investor community. The round got oversubscribed. The lead investors on the round were leading venture capital funds in West Africa, so in Africa overall, sorry. So E3 Capital, Django, and Kavisafi, they invested in this round. And we got a lot of support because we had execution first approach, I would say. And because our approach to fundraising was never transactional, and I think that's what a lot of founders get wrong, because they look at things transactionally versus focusing on building right relationships. Because investing, from my experience, is all about relationships, about alignment of values of people, what they want, and alignment of why. I think it was on one of the previous sessions, it was mentioned that it's one of the core investment criteria, especially at the seed stage. It's alignment of this why element. I think I can carry on and eat all the time.
No. So I want to just stick with you because you answered my second question on the perspective from your investor seat. But as the point I want to drill down on is this financial discipline. Yes. You've kind of given us a insight on how you thought about the valuation, the amount, kind of having a sober mindset around that, and getting funders with alignment. But when now you're thinking about future growth, right? You're expanding into multiple markets. How are you thinking about balancing growth, but also kind of maintaining that defensibility in your model to weather the volatility?
Yeah, first of all, we built a business model which is a hardware-based, but has a software industry margins. And that was very important because my background before, I've been investing in tech. And the longer-term vision for our business is in the credit space. So we see, and the whole hypothesis when we started, initially I came into Africa with the hypothesis of starting a credit fund. So we wanted to do a credit fund financing consumer tech startups, consumer fintechs, sorry. And with that trip was like 3 years ago. I came actually to Nairobi first time, and during that trip I visited 10 African markets, and we, as a result of it, we understood that the whole ecosystem is too early. So if you do a fund, it's going to be too small. But we chose cars as the most capital intense industry where we can show quick results. And but obviously the vision we have is much bigger than just one category of consumer finance. And in terms of financial discipline, we have rule-based approach because we are asset managers. So my co-founder, we know each other from investment banking. He is originally from Cameroon. So we've been investing together for 7 years. And both of us, we are finance people. So when we choose a market, for example, we don't have any aspirational kind of feelings of love or any attachments. We look at the numbers at the bottom line. I mean, what's the payback period? What's the FX risk? How we can hedge? Is it investable or not? So that's the criteria, which is very important because no one anymore cares, I think, about nice presentations and this good-looking slides. So it's more about the bottom line.
Yeah, show me the money.
Yeah, exactly.
Wendy, I want to move to you now because I think you have very unique perspective. You've built Vivo into one of the largest fashion brands in East Africa and a more traditional kind of brick and mortar business relying on family and friend funding. But you also co-founded Shop Zetu, which is a tech platform, which is a fashion marketplace as part of the distribution channel for Vivo. So you can speak to both, what it means to scale a traditional business and manage volatility with that, and a tech-backed business. But what I want you to speak about, first, give us the Vivo history and you touched a bit on it in your introduction, on the growth you guys were able to achieve and a bit about the fundraising story with Vivo. And talk us through how you were able to navigate when the market turned from a Vivo's perspective, and then shed a bit of light from a Shop Zetu perspective as well.
Yeah, so Vivo, we started with personal savings, $100,000. And luckily, we were profitable from year one, and we just kept using that money to reinvest and grow the business. And after about 5 years, I put together a real board, and the directors looked at me and said, "Why are you growing so slowly? You could go faster." Sometimes women need ambitious men sitting around them. So we went from opening sort of one store a year to about 4 or 5. And my question was, where would we get the money from? Like, I was used to only using what was in the account. And they said, you just raise it. And they were willing to put in a bit of money themselves. And I asked a few other high net worth people that I knew. And so that's how Vivo grew. When we decided to create Shop Zetu, I brought on board a co-founder who understood this world that you are in, this VC language, VC world. I still don't quite fully understand it. At the time, Vivo was doing about $5-6 million in revenue, and we had raised a little bit more money at about a $5 million valuation. And then we put this Shop Zetu thing together, and within a few months, my co-founder was able to convince people that it was valued at 5 million. And I was like, how is it even possible that, this company that's hardly doing any revenues yet? And within less than 6 months from then, a second round, which was then valued at 9.5 million. So even more than what Vivo was valued at. But this was 2022, 23. So when I'm listening to your stories, I'm like, okay, we clearly got caught up in that wave. And I think the pressure that put on this co-founder, who was the CEO of Shop Zetu, was to also grow just as quickly. And so the $1 million that was raised basically got spent in a year, half of it on marketing and trying to grow very quickly in a way that I personally have never done at Vivo. So very different expectations, very different timelines of how quickly you must grow. And, when we ran out of the first $1 million, at that point, the valuation was going to be 20% of what we had raised it at a year before. So we decided not to go to market. And luckily, Vivo, because Vivo is profitable, has been able to carry Shop Zetu. But in order to do that responsibly, we cut it down significantly. A team of what had been almost 60 people went down to 12. And we were doing roughly the same kind of revenue. So you sometimes wonder, what were all these other people hired to do? And what was all that money that went to Meta ads really supposed to deliver on? And now we have a very different approach, and it's going to be a smaller business, but we're going to get to profitability this year, so it stops bleeding. And we will have it be part of the Vivo story rather than a separate story. And we think our exit for Vivo will be probably a 2-step journey of some sort of private placement and hopefully an IPO on the Nairobi Stock Exchange in the next 3-4 years.
Amazing.
Thank you.
So I mean, that deserved a clap.
Well, no, because it hasn't happened. I mean, this is the hope, but who knows if it's actually going to happen.
Exactly. But I think you also just touched on some of the mistakes that were made, the lessons learned, and pivoting based on those key lessons. And before I move to you, because I want to touch on the NSE, liquidity opportunity. But before I move there, how are you thinking about, especially from a Shop Zetu perspective, managing profitability, but also taking advantage of the growth opportunities that lie ahead for the company?
Yeah, like I said, we've changed the model. You know, I think in the beginning it was like grow it as quickly, get as many vendors on the platform. I mean, the truth is that in this ecosystem, there aren't 10,000 fashion brands that can all list. So, you know, we'd rather make it more boutique-y, maybe have 50, 60 solid brands that can supply. I mean, the Vivo brands already make up more than half of the sales on the platform. So what we're trying to prove with that is the e-commerce opportunity for fashion and get really, really good at that. So when we're selling the group, whoever's buying it is also buying this entire e-commerce platform with all the data that's going to exist in that and the customers that we've already acquired.
Got it. And so now moving on to the future of potentially listing on the public markets. Can you just shed a bit of light on this NSE Booker program that you guys joined, and how is it helping you get ready for that future?
So yes, NSE has a program where they sort of help companies that they think will at some point soon be able to list. We were part of that almost 2 years ago, and to be honest, we haven't done anything since. But it sort of helped us understand what it would take. I think what excites us now is the opportunity not just for the institutional investors that hopefully would come on board, but also for the retail play, being a quite well-known brand with a lot of consumers. This would be a chance for us to allow consumers to become investors. Things like the ZD platform that Safaricom has built with NSE, I think would make it very easy for people to do that. And so, yes, I think we need to wait for the elections to come and go. And in the meantime, we want to grow in these other markets, like expand a bit more in Uganda, possibly look at Zambia and Tanzania, so that even if we list on the Nairobi Stock Exchange, we're a business that doesn't rely so heavily on the Kenyan market.
Got it. Now, we have 10 more minutes, and I hope to leave maybe 3 minutes at the end for 1 or 2 questions. But just as a closing shot for all of you, you've shared about how you're thinking about building for resilience, but there are also VCs in this room, right? So what is one thing you'd like to see more of, or how can more of or better at from the VCs and PE funds operating in Africa?
You want to start?
Whatever that may be.
Yeah.
Feedback, basically.
Yeah, feedback. I would say that for me, because I'm relatively new in Africa, it was the surprise was the time it took for the seed round to close. And because in the UK, in the US, for seed investment, it takes maximum like 4 to 6 weeks. Here, I would say VCs, they have approach on more like detailed due diligence, having external due diligence, and it takes quite a long time. So more like a private equity approach rather than early stage VC. So that obviously limits a number of investees, a number of startups. And what I also found as well is that Africa has a lot of talent, a lot of people who tried, who failed, who learned. And in our hiring strategy, we hire founders. We hire former founders and we focus on them. We never hire corporate people because we know that these founders are builders. So they know how to build fast and experiment and build startups. And we support them because I think, honestly, the whole ecosystem of supporting them is quite not there. And that's why we, have ongoing vacancy of entrepreneur or in residence for any former founder who wants to join GoCap. So that's the approach we've been having.
Amazing.
Being a seed stage startup.
Yeah. JC, would love to hear your take. And even as you're thinking about, the tough times that Laurie went through with the restructure, how would you have liked the investors to lean in more, or would you have liked to see anything differently from your investors at that moment in time?
Sure, thanks. I'd say one big lesson for us leading into the restructure was the difference between having aligned sort of culture and incentives in having African-focused investors on our cap table versus opportunistic investors, which is what Laurie started with. But perhaps the advice or what I would have loved to see and what I would still like to see going forward is for funds to structure their funds not just based on how Silicon Valley operates and has worked historically and how the VC space has worked historically, but iterate on their model based on the reality of what we see on the continent. And the reality of what we see on the continent is that, first of all, as Azamat said, everything takes more time. And it really isn't a lack of good faith from the founders when they try to estimate how much time things are going to take. We really try to be accurate, and yet it still takes more time. So that's one thing that I think most founders and investors on the continent know, and yet I don't think it figures in the structure of the capital. Model. The second is that there are going to be micro pivots and micro shocks that are going to contribute to those delays. And whereas Silicon Valley funds often have, maybe 30% of their fund for follow-on investments, it feels like in Africa, if you actually want to see your portco get to an exit, which is likely to take 10 years, you probably have to allocate a greater percentage to follow-on investments. Even if those follow-on investments are sort of more rounds of smaller tickets, it will likely happen. And, by the sort of third, fourth, fifth rescue, you likely have a winner.
So venture capital that's fit for purpose for Africa, but also creating that capital stack so that the founders can grow and have the capital to meet them at that point. Wandia, any...
Can I use the microphone?
Any kind of feedback points for the VC PE industry, especially given the whirlwind with Shop Zetu?
So maybe just to speak on a more human level. I said when I started that I didn't know much about VC. I still don't. And I sit up here on this stage and I'm looking around the room, literally 70% of you have been on your phones the entire time we've been talking. And that's how VCs come across, at least to me. Like it's very often like you're just really not that interested in the founders or in what we have to say as people. And not all of you, but in my experience, and when we were raising for Shop Zetu, we probably spoke to 60, 70 different VCs. Many were very arrogant, quite rude, made you feel less than. It's like you leave a conversation feeling like your business isn't worth it. And it's okay not to invest in a company, but I don't think it's worth having that kind of impact on the people you're speaking to. So I just think treat founders with a bit of respect, with a bit of kindness, and it's okay to say no, but just be kind in the process would be my advice.
Amazing. And I think, Azamat, this goes to your point on you're building human relationships, right? Exactly. It's not transaction. And on both sides, you're building the human relationship with the founder, and the founder's building a human relationship
and
with you as
do talk to each other.
Yeah, yes.
They really do. They really, really do.
Founders talk to each other. So we have 4 minutes left. I would love to open it up to 1 or 2 questions. And even though you were on your phones, I want to believe you were listening. So please don't be shy. Any questions? Go ahead. There's one question here. I don't know if you can get him a mic, or maybe you can. Oh, there we go.
Hi. Thanks very much to the panel. It's been really interesting. It's actually a question mainly for Jean-Claude. You mentioned a little bit about sort of when the market was flying, you raised at very high valuation, took capital from, I think, some investors from overseas. I guess the question is, was like in hindsight, would you have done something differently? I guess it's difficult to say no to capital coming in at really generous and attractive valuations at the time. So I'd just be interested to know, looking back, whether you would have maybe not taken that capital or structured it differently.
Sure. So looking back, I will speak from both sides of my mouth here. Looking back, it was not the right thing to do, but if you reran the whole experiment with the experience that we had as founders at the time, what the market bore, it didn't feel like a mistake. Like we were doing what every company we had followed the story of did, right? Like, you know, we raised a seed round, we grew, we showed the numbers were very attractive, not profitability numbers because no one really cared about that, but our growth numbers were incredible. And then, you know, we were offered well, actually, interestingly enough, there was a fund, there was an Africa fund that took a look at the deal. They were interested, and they offered us a valuation. And I remember we were a bit disappointed because of what we had heard a valuation should be. And then a month later, a foreign fund came and gave us that valuation. With hindsight, the African fund was already onto, you know, more reasonable valuations, but we did not know better. Knowing what I know today, yes, I think I would approach it very differently because now I understand what my preference would have been, should have been. My preference should have been, like Azamat said, right? Like raising as little as I could to get to cash flow positive. And then using my position being cash flow positive to raise what I needed at a better valuation to grow the way we wanted to build the company. So just in general, we used to think of profitability as something that you do after you grow, whereas I think the zeitgeist today is that more founders are thinking about proving product market fit and market opportunity by being cash flow positive early, and then figuring out how to grow profitably or near profitably, right? Where your burn is never astronomical because you know how to operate profitably. So if you have to cut marketing or you have to cut hiring to get back in the black, you know you can do that. So things have changed, but we had to learn the lessons the difficult way.
Great. I think I don't want to risk.
There's one more
question.
question.
We have one more minute, so please go ahead.
Thank you. Armando from Gestion Fonidi. So a question for Wanda. First of all, sorry, I was on the phone. But I was checking your background and I even sent you a LinkedIn invitation.
You're forgiven.
Please don't worry. So in your view, down rounds in our markets are due to failure of execution or more about over-optimistic capital chasing narrative?
I think it's in the experience that I've seen, or at least what what we went through, it was the latter that led to the first. I think if you overvalue and you put all this money in, obviously you have high expectations, and then the founders will be under so much pressure to scale so quickly that they'll make sometimes bad decisions.
Thank you.
Thank you. And we are at time. Thank you all for your time and thank you for your attention.